Hey everyone, welcome to the first video of the Finvest Studies. You would be having the question in your mind that what makes big investors keep courage in them and hold their portfolio stocks for years, and how they face every single up and downs of the market without any fear and make them stand like a wall when situations are not likely in their favor, such as crisis, correction or a market crash. Even many retail or small investors have questions in their minds as to why some big sharks such as Rakesh Jhunjhunwala, Radhakishan Damani, Vijay Kedia, who are known as big sharks in the market, keep stocks in their portfolio though they are getting huge profits and don't even dare to sell 1% of the stakes in that companies. Let's solve these queries, so watch the video till the end. If you like it, give it a thumbs up and subscribe to our YouTube channel. Without any wait, let's get started. We retail or small investors probably book our profits because we as retail investors have a FOMO in ourselves that if our stock gets profitable within a few days or weeks, we sell it because our targets get achieved. Or we have a fear that we will miss profits as if stock is going to reverse from that point of time and price. Or in circumstances, we also sell our investment in losses because in fear of losing whole capital. So I will be discussing 5 major reasons in the further video why big investors doesn't sell any single share from their portfolio and how he sets apart. Number 1. Why not sell in a panic situation? Retail investors start selling blindly as they don't want to lose their hard-earned money. In this case, long-term investors plan their investment for their retirement or their financial goals. At this time, one should always remember that market is a cyclical in nature. Nobody can prevent the movement of stock, but a downturn is always temporary. In this situation, one should think like a long-term investor that the market and the economy will recover. Have an eye on market crashes and what we learned from them. Even during this pandemic, you can see BSE Sensex went down up to 25,981 on 23rd March 2020. It's all-time low, and in September 2020, it has recovered back to the same position where it was in September 2019. Also, Sensex has hit an all-time high of 62,245 in October 2021. Even in the crash of 2000, market grew significantly from 2002 to 2007, giving a 529% return in 5 years. We have also seen the market crash of 2008, which resulted in a rise of 120% in 2 years. And after all the fall of markets in demonetization 2016, investors earned 34% returns in 1 year. So it's sure investors who endured these difficult times and stayed invested were the ones who got the best return. We should accept the fact that the market crash and economic slowdown would never go away, but we must always stay consistent in our investment and do not follow our emotions to come into play while investing. But are you aware the reason is after every dark night there's a brighter day waiting for you? We have seen this after every decline in history. No matter how severe they may be, investors have recovered their losses and the market has seen positive growth over the long term. This is the time when investors' capital compounds at a great pace and the market have always outperformed. It tells that at these times you must not forget the quote of the famous investor Mr. Warren Buffett, which says, "Be fearful when others are greedy and greedy when others are fearful." These times can be great opportunities to buy more at low prices rather than selling your stocks at loss. Number 2. Power of compounding and dividend income. How does it change your life? Long-term investors have the eighth wonder of the world is compounding. Compounding is nothing but the interest earned when interest payments are reinvested. Particularly in context of stocks, the idea is to stay invested as much as possible. Frequent selling or buying or selling the stocks in panic would not help to grow your wealth. It helps long-term investors make a passive income known as dividend and is received by them in quarterly, semi-annually or annually. As retail investors, we sell our stocks in a hurry and take out money from the market because of fear, which let us earn profit, but it stops our dividend income and other incentives given by the company. You might have seen some news on big investors, and are you aware this is for sure they would be earning this kind of return easily. These articles shows Rakesh Jhunjhunwala, Radhakishan Damani, Vijay Kedia, has outperformed the market returns in some years. These articles are not fake, as the thing is they have great knowledge that how compounding a single stock will make their portfolio green. Number 3. What the buy and forget strategy is. What if I say you buy and forget stock for 10 years? No one will agree easily, but it works. Let us have a detailed explanation. Big investors or long-term investors buy stocks and probably forget them for years as they know that these stocks will add value to their portfolio and will generate huge returns. Some example of multi-bagger, like in April 2010, Avanti Feed share price was at rupees 1.6 per share. Multi-bagger stock turns rupees 1 lakh capital to rupees 3.37 crore, and currently the stock is trading at rupees 562. The company has delivered returns of 35,614% since inception. In 2010, Bajaj Finance prices shot up from rupees 33 per share to rupees 8050, to date lugging around a 1,55,600% rise since inception. Also, Astral Polytechnic share price has zoomed from rupees 12.6 in April 2010 to rupees 2524 on BSE. Over the years, it has managed to give a return of 32,559%. Also, if we see some stocks of 2021 which have given so much that no one would have expected, share prices of KB Technologies surged 330% in 2021. The Indian Energy Exchange shares climbed 125% in 2021. Shares of Adani Enterprises jumped 131% in 2021. Happiest Mind stock surged 166% in 2021. Balaji M1 share delivered 86% returns in 2021. And if we talk about small caps, investment of rupees 1 lakh in Transit stock in January 2021 is now worth rupees 5 lakh. Investment of rupees 1 lakh in Poonawalla FinCorp has been rose almost 5 times to over rupees 4,80,000. So by seeing this, it can be said that these are insane returns and surely beating market average returns of 14%. Number 4. Less costly. How investment can reduce costs. Like a single penny saved is every single penny gained. Any gains from stock sales must be filed for the income tax return. That ends up increasing your tax liability, which means more money out of your pocket. Let's evaluate this. Remember, short-term capital gain can cost you more than if you hold your stocks for a longer period. Then there are trading or transaction fees. How much you pay depends on the type of the account you have and the investment firm that handles your portfolio. For instance, you may be charged a brokerage or STD when you buy and sell through a broker. These costs are charged to your account, and also there are many hidden charges whenever you trade stocks. This means your portfolio balance will drop with every sale you make. If we look towards some success stories, Rakesh Jhunjhunwala holding Titan worth rupees 11,166 crores, Radhakishan Damani holding VST Industries worth rupees 1,556 crores, and Vijay Kedia holding Tejas Networks worth rupees 188 crores. These stocks didn't just create returns for them but also a great passive income for them. These slides will tell their success stories. You can surely refer to them by watching the video again. Number 5. Risk drop. What if one of your stocks comes down drastically, but it doesn't affect your portfolio? The answer is diversification. Diversification is the best formula to drop your risk. Diversification of your investment can ensure maximum profits. Example, buying stocks like HDFC, DMart, Reliance, TCS, Tata Motors. This also secures your capital. It is simple to understand. Let us say you have 3 eggs in one basket and you lose the basket. What happens? You lose your eggs. Therefore, it is always wise to not to put all the eggs in one basket. This is exact strategy you need to apply with your investments. You get to do much more effectively than it sounds with long-term investments. You get the time to think, monitor current investments, and look forward to making investment as per your current portfolio. Because sometimes comes when we get a hot tip and we put all of our capital in one stock, and after that, if that stock doesn't perform well, we face huge losses. So it's better to keep a diverse portfolio so that other stocks can cover the losses of our portfolio. Even if we look at the portfolio of sharks like Rakesh Jhunjhunwala, Radhakishan Damani, and Vijay Kedia, they also have stocks that are not performing, but still they are earning it due to the diversification of stocks in their portfolio. You can surely refer to these slides. Now the thing comes, many people will also have a viewpoint that the wealth of investors like Rakesh Jhunjhunwala, Radhakishan Damani had come from insider trading or any other methods. Can be, but the current market situation tells us that maximum money made by them is due to they are holding stocks from a long period in this bull run. Also, the main question comes to the mind: what should retail or small investors learn from these big investors or sharks, and how they can maximize their returns in markets and become a more profitable investor? The answer is simple. In the end, what matters is you understand your money and invest in a vehicle that will ensure good returns over time. You can invest in some of the standard company stocks to make sure your investment is in the right hands. Take a look around, see what is happening, and make the decisions based on facts and information. If you want to run clear of all these burdens, go for a long-term investment plan which is sure to help you reach your financial goals and not much of a threat to your pockets in the long run too. The best example is every good quality batsman has a certain style of batting. However, each good quality batsman would be able to accumulate a lot of runs if he continues to play for years, not only in a single match. Note this. And in this video, I am not against someone who is making a good income from short-term trades, intraday trades, or any segment of investing. It just discusses the benefits of holding stocks in the long. That's all from my side today, guys. Your homework is to give it a comment who is your favorite long-term investor and discuss your long-term investing strategy. I hope you liked and enjoyed the video and surely got something valuable to learn from it. For more knowledgeable and business related videos, please subscribe to our channel and like it. That would mean a lot to me. Thank you so much for watching and I will see you in the next video. Till then, goodbye.